welcome to another video. If you're new to the channel, I'm a top holder on the TRADINGVIEW platform as well as running an educational program and swing trading full-time with my students. In this video, we will be speaking about EURUSD, seeing how we can approach it from a multi-time frame and order flow perspective. And in fact, we already did it with the last analysis that we made on it, predicting this very nice push to the upside, because obviously we were seeing what banks were doing on it. So we will be speaking about what we can expect next and seeing obviously how from an educational perspective we can always try to take the best swing trades out there for the best risk to reward and probabilities. So I will invite you to check out the video until the end because it will be very educational. I spoke about EURUSD in the last analysis on TradingView. You find the link here, and we were expecting a push to the upside. Well, the reasons for this were many. First of all, from a technical perspective, we definitely wanted to see a push to the upside from our multi-time frame analysis that we made, and obviously showed you how to do it. But also we could clearly see from a COT perspective, as I will show you also in this video. So from a commitment of trader perspective, so what hedge funds were actually doing, what we were seeing is in a market that was going to the downside, they were closing their short positions. So definitely, what do you expect after something like this? You expect an accumulation of long positions and the market to make a push to the upside. So let's see exactly what we had on EURUSD and what we can expect next to capitalize on the next moves. Okay, so what did we expect on EURUSD to see this move to the downside here actually become a fake breakout of this previous low and make this push to the upside, and what we can expect next on EURUSD and how we can capitalize on the next moves on this pair. So first of all, what we could clearly see from this area, okay, what we could see is that the market had reached this previous support here. Now against support, the market breached it below, and what we said on TradingView, okay, I made a full analysis on TradingView when the market was around this area here. You find the link in the description. And what did we say? We said this area will probably, this push to the downside will probably end up being a fake breakout, and the market will break back above and make a nice impulse to the upside, going and testing which zone, which one was our upside target for this move to the upside. It was exactly this area here. Now, why was exactly this area here? Because keep in mind that in all of this push to the downside, in all of this huge impulse to the downside, there is one candle that is not related to the move, which is this green candle here. So what this tells us? It tells us that market makers and big institutions are interested in this level because they reacted as soon as the market actually hit the zone, and that will be now turn resistance. Why? Because in this push to the downside, the market had basically reacted so much to the level that it actually created a green candle, and that previous support, since the market is now coming from below, is turn resistance. A very simple and basic previous support turn resistance concept that in the market happens over and over again. Now, going back to the main question, why did we want to see this push to the upside? Because if we go and see what was going on from a COT perspective, so the positioning of hedge funds on EURUSD, what we could see, we could clearly see that during the push to the downside, okay, we have just seen that EURUSD was making a nice long impulsive phase to the downside. Look at what was happening to the short positions of big speculators in the market, so the non-commercials. What we could see on EURUSD is that they were closing up their shorts. They first closed 33K, then they closed 72K, then they closed another 51K, then they closed another 23K. So what was happening is that during this push to the downside, hedge funds were actually closing up all their short positions. Just a quick reminder, make sure you comment below and you let me know which pairs you would like me to cover in the next video. Now, if the market is going to the downside, okay, you have a market that is impulsing to the downside and hedge funds are closing their shorts instead of adding them. Now, if you want to bring price lower, you have to add shorts, right? If you're closing them, what does it mean? It means that you're not interested in bringing price lower and you just want to accumulate some longs from this area and then bring the price higher, right? That is exactly what it means. So what does this bring to? It brings us to the conclusion that this push to the downside, what did they need in the first place to make this push to the downside? Why did they need to make this manipulation and basically break below this previous support, now turn resistance? They needed to create this manipulation for one very simple reason. They have so much money that they can't just press the button and open a trade as we do. Okay, so what do they have to do? They have to create the liquidity that they need to actually open up their position. So what happens? What happens is that if they breach this level to the downside, basically most of retail traders will actually start shorting. Okay, previous support, now turn resistance, the market created a lower low, let's short. Everything is pushing to the downside, let's just short. That is perfect for them because they will use all those shorts to actually buy, right? Because for every seller there has to need, for every buyer there has to be a seller in the market. So if they want to buy, they need to create the sellers because there aren't enough in the market for the amount that they actually want to buy, which is massive. So there's a very important concept here that we had to speak about. Now, that is the main reason for which we wanted to see this push to the upside, but there was even more. Okay, what did we have from a weekly perspective? Now, from a weekly perspective, we had this very strong support here and the market was exactly here. So we could expect perfect fake breakout to the downside, retest of support. We expect a huge push to the upside because they are not selling. And in fact, with the next report, what we can see, they have added 5.2k longs and closed another massive 23k shorts. So very nice impulsive phase to the upside on Euro USD. Now what we can expect next for this pair, okay? When is the next opportunity to capitalize on it? No matter if you did take the swing trade to the upside and you did follow basically my guidelines and obviously applying your own strategy, because it's very important that you trade your own strategy because you don't know the rules of my strategy, okay? So you need to have a strategy that needs to be tested. You need to have clear rules for entry, exit, take profit. Everything must be tested, back tested, both back tested and live tested, and proven profitable. Okay, now let's speak about what we can expect next, and most importantly, since trading is reactive and not predictive, where are the best probabilities for the next push to the upside? Well, the best probabilities are after a retracement, right? Why? Because we already said that this area is clearly previous support, which is now turn resistance, and we clearly wanted to see a shift away from the area, which is now happening, right? And in general, in the market, after an impulse, usually will follow a retracement most of the times. And after a retracement, we can be looking for another impulse to the upside, right? Specifically, after such a very strong impulsive phase to the upside from a weekly perspective, as we have just seen. And as we have just seen, they definitely added 5.2k longs. They probably did it for a reason. So where are the best probabilities? Now, it would be great, really great, to see the market actually make a retracement even lower, okay, all the way to here. But probably that won't happen, okay? Now, there is nearer support, okay? Across this area here, even a little bit lower would be great. Around this area here would be great. Go and test this support here. However, that is not really important. Why is not really important exactly where? Because anyway, we can't predict the market. We have to react to what the market is showing us, meaning that anyway, what we will be doing with students, we will be monitoring price action during this retracement on the 4-hour time frame, waiting for the market to start shifting from a bearish market to a bullish market from a 4-hour perspective. So letting the market show us its hand. So no matter where exactly the market will find its support, what we will be doing with students, we will be monitoring price action all inside of this area. We will obviously have some nice confluences over Fibonacci, because taking a Fibonacci from the low to the high of the impulse, what do we get? We get that the first Fibonacci levels are around this area here, 382, 50%, which is obviously not a Fibonacci level, but it's a strong level when it comes to retracement. The golden ratio are all lining up inside of this area. So what we will be doing with students, when the market will hit this area, at least at 382, what we will be doing, we will be waiting on the 4 hours for the market to shift from a bearish market to a bullish market and provide to us one of our valid entries, because it's of key importance that the market actually provides to us one of our valid entries. So after the market will drop inside of this area, and after the market will provide to us one of our valid entries, then what we will be doing? We will be taking a nice long with a good risk to reward and very good probabilities for a nice push to the upside and continuation for the completion of this impulse correction and impulse pattern to the upside and continuation of the bullish momentum that we have seen from a weekly perspective, and possibly the adding of more longs by part of the hedge funds. So this is overall what we have for EURUSD. Obviously, when I mean good risk to reward, I mean a minimum 1 to 3 risk to reward. We don't take a trade if we have less, because even if you have a terrible win rate, and that can happen at some points, everybody has a losing streaks, but anyway, if you have a minimum 1 to 3, even if you write only 3 times out of 10, you're still in profit. So there's no way that you will not be long-term consistently profitable with a 1 to 3 risk to reward. And that is basically the key to consistency in the market. So waiting for the market to drop here, and then we will be monitoring for a push to the upside. Obviously, if the market will just continue to break to structures to the downside and create lower lows and lower highs, then obviously we will have to adapt to the new market structure, and I will try to keep you guys also updated or here or on TradingView. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more education and analysis for all of you, as well as going and checking out the mentorship program that you find with the link in the description. It's a very complete program. You first get all the rules of my strategies, and then you trade them live with me. Each and every day I give you a new daily market breakdown showing you exactly how you're supposed to be applying the strategies with entry, stop, take profit, as well as answering every question that you have each and every day. So it's a very complete program. I suggest you go and check it out, or go and watch the next video.